Welcome! In this video, we'll dismantle the myth that starting to invest in your late 30s is too late. On the contrary, now is a powerful time to begin. We'll cover why consistent contributions and low fees matter more than timing the market. And we'll give you an actionable plan you can implement today. Let's move from fear to a clear system that compounds for decades. Here's our roadmap. First, we'll reframe why the late 30s can be an ideal time to start investing. Next, we'll outline a practical, low-stress plan that begins with an emergency fund, adopts dollar-cost averaging, and automates contributions. Then, we'll emphasize the power of low fees and broad diversification through index funds, or ETFs. After that, we'll share a simple portfolio example and rebalancing guidelines. We'll also include short quizzes to lock in your learning. Finally, we'll wrap up with key takeaways and your next steps. Let's begin by busting the myth that you're behind. Even if you didn't start in your 20s, your late 30s still offers a 20 to 30-year runway for compounding. Rather than focusing on past missed opportunities, we will redirect attention to the power of decisions you can make today. This shift from regret to action is key to achieving long-term security. In your late 30s, you often have more stable income and clearer life goals. More importantly, you still have enough decades ahead for compounding to be meaningful. Even small, regular contributions, such as €500 a month, can translate into substantial future sums. The reduced appetite for risk typically encourages a disciplined, system-first approach that emphasizes broad diversification, automation, and avoiding speculative bets. This is precisely the mindset that tends to win over the long term. This flowchart visualizes the entire plan. We start by building a 3 to 6 month emergency fund. Once that buffer is in place, we set a dollar-cost averaging plan to gradually invest any existing savings over 6 to 12 months. Next, we automate monthly contributions so investing becomes a habit. We choose low-cost, globally diversified ETFs for broad exposure to thousands of companies, and we rebalance annually to maintain our target asset mix. Finally, we commit to staying the course through market ups and downs. Here is your starter plan. First, hold 3 to 6 months of expenses in cash as an emergency fund. Second, set up a dollar-cost averaging schedule for any existing savings. Third, automate your monthly contribution, such as €500 each month. Fourth, select low-cost, globally diversified ETFs to minimize fees and maximize diversification. Fifth, rebalance annually to keep your chosen percentages intact and avoid reacting to news cycles or daily price moves. Dollar-cost averaging spreads your entry into the market over time, which reduces the risk of investing a large amount just before a downturn. In this example, we invest 8% of the lump sum each month for 11 months, and the remaining 12% in the 12th month. This approach helps avoid decision paralysis and keeps you progressing while markets move up, down, or sideways. It also complements your ongoing monthly contributions, reinforcing your investing habit. Quiz time. The question is, what should you do before starting your dollar-cost averaging plan with existing savings? Option A. Put the entire lump sum into the market immediately. Option B. Build a 3 to 6 month emergency fund first. Option C. Wait for a market crash before investing. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Building an emergency fund first protects you from having to sell investments during a market drop to cover unexpected expenses. This safety buffer helps you stay invested and stick to your plan during inevitable volatility. Let's compare approaches. High-fee agencies typically charge 1 to 2% or more annually. Those fees compound as a drag on your returns, often packaged in complex products with opaque costs. Over decades, the difference can be massive. By contrast, a low-cost approach that uses broad index ETFs keeps more of the market's return in your pocket. The simplicity also reduces behavioral mistakes, improving your odds of reaching long-term goals. This table illustrates how fees impact long-term results. With €500 invested monthly for 30 years, a low-fee indexing approach at approximately 6.85% net could reach around €600,000. A high-fee alternative at approximately 5.5% net may reach only around €460,000. These figures are rough estimates and not guarantees. but they demonstrate how small fee differences can create six-figure gaps over the long run. Here's a simple structure. Use a global equity ETF for growth and a global bond ETF for stability. Choose a stock-to-bond mix that matches your risk tolerance and time horizon. For many late 30s investors with a long runway, something like 80% stocks and 20% bonds can be appropriate. But you should adjust according to your comfort with downturns. Rebalance annually to bring your portfolio back to target weights. This timeline shows the long arc. Initially, you set your emergency fund and automate contributions. Over the first 5 years, you focus on consistency and learning the basics while ignoring daily noise. From years 5 to 15, compounding accelerates and pay raises can translate into higher contributions. Between years 15 and 25, you continue rebalancing annually and clarifying goals. In the final 5 years before retirement, you may adjust the portfolio to manage risk, bolster cash reserves, and maintain diversification. Automation replaces willpower. Set transfers to occur immediately after payday and pre-select the ETFs and contribution amounts. Enable dividend reinvestment to keep compounding uninterrupted. When volatility spikes, default to staying the course rather than making emotion-driven changes. Automation prevents decision fatigue and helps you keep investing through all market conditions. Here's your second quiz. Which matters more for long-term success? Option A, timing the exact market bottom. Option B, time in the market with consistent contributions. Option C, picking the hottest individual stock. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Over long horizons, consistent contributions and time in the market are far more reliable than attempts to time bottoms or chase hot stocks. This consistency lets compounding do the heavy lifting. A quick but important note. This video is for educational purposes only and is not financial advice. Your situation is unique. Before acting on any strategy, do your own research and consider consulting a licensed financial advisor who understands your specific needs and risk tolerance. Let's summarize. Starting in your late 30s remains powerful. Focus on the decades ahead. Build your emergency fund first. Then use dollar-cost averaging for any lump sum and automate your ongoing contributions. Opt for low-cost, globally diversified ETFs to reduce both risk and fees. Rebalance your portfolio once per year and maintain discipline during market swings. Above all, consistency and low fees are the primary drivers of long-term wealth. To wrap up, the best next step is to open a low-cost brokerage account and set up your ETF plan. Automate a monthly contribution immediately after payday so investing happens without friction. Add a yearly reminder to rebalance and review your goals. Continue learning as you go, but avoid analysis paralysis by leaning on your automated system. Thanks for watching. If you found this useful, please like the video, share it with someone who needs the encouragement, and subscribe for more practical investing guides. In the comments, let us know your first automated step. Are you starting with your emergency fund or setting up your DCA? Your plan begins today.